Hi, everybody, and welcome to today's webinar, Central Bank Digital Currency, the Future of Money. My name is Rohini Sanyal, and I work as a global research economist at the ISI Emerging Markets Group. And joining me today on this webinar is Rosita DiCunha, who works as a research analyst for EMIS, and specifically EMIS Insights. And Rosita brings with her this rich experience in sectoral analysis, having spent more than a decade covering different sectors and in different markets. So at the ISI Emerging Markets Group, she covers a broad range of sectors, again, across different markets in Southeast Asia. She is passionate about investment world and enjoys writing on personal finance and investing. To give you a little bit of background about what we're going to talk today, I'm sure many of you are aware of how the payments infrastructure, has seen this rapid influx of private digital currencies, which has created this, whole new parallel universe that stands to sort of undermine the authority of central banks. And in response, central banks have accelerated the exploration of digital currency, namely the central bank digital currency, to stay relevant in a fast evolving digital scenario. Research by Atlantic Council Geoeconomic Center reveals that 114 countries are currently exploring CBDCs, central bank digital currencies, which comprise 95% of the global GDP. And in the case of India, the concept of digital rupee was announced by the finance minister at last year's budget session, which was for financial year 2023. And since then, the country has sort of commenced both wholesale and retail CBDC pilot projects in December. But before we sort of get into more about the central bank digital currency, I would like to mention a couple of points that will help us interact during this session. First of all, in today's webinar, you will have the opportunity to ask questions. All attendees are on mute, so you can submit your questions in writing using the question panel on your right, and we'll answer as many as possible during the Q&A session at the end. Secondly, we also have a handout section just above the question panel, and we have uploaded our presentation there, and you can download it for your reference. And last but not the least, at the end of the webinar, we have a short survey to capture your feedback and expectations. So please just take 2 minutes and let us know how you liked it, and if there's any way we can make it better for you. So many of you have already been a part of our webinars and know a great deal about the company, but for those of you who are joining us for the first time, the ISI Emerging Markets Group has been in the business of providing information on emerging markets specifically for about 30 years, over 30 years now actually. And the group has 3 brands: CIC Data, which provides macroeconomic data on more than 200 economies, EMIS, which focuses on company, industry, and country research on emerging markets, and Red Intelligence, which is our newest addition to the banner, and it's a global leader in distressed and event-driven special situations intelligence on emerging markets. So without further ado, I'll hand it over to Rosita to take us through more about central bank digital currency. Over to you, Rosita.
Thanks a lot, Rohini, for the introduction. Indeed, central bank digital currencies have been in the spotlight in the recent past. There's been a flurry of activity there, not also because there have been divergent views on whether central bank digital currencies are really required or not, and what the use cases are for CBDCs as we know it. We'll start this presentation with the definition, and then we'll go on to identifying what has been the catalyst for so much activity in the space in the last couple of years. We'll touch upon what is happening in the global markets internationally. Then we'll move on to see what is it that RBI expects to achieve, through the launch of CBDCs, the goals. We'll look at, how RBI visualizes the implementation of CBDCs to be. We look at the design features, some challenges, and then we'll come to whether CBDCs are really whether CBDC should really be launched or not. So I'll start with defining central bank digital currency, also called as CBDC. It is issued by the central bank of the country, and in our case, it would be the Reserve Bank of India. It is in the electronic form. It is a fiat currency and legal tender, Now, by this, I mean that, in case of a physical currency note, you would see that the RBI governor, promises to pay whatever the amount is, on the currency note. Similarly, this CBDC will be sovereign backed, and therefore it is a legal tender. The RBI governor very succinctly put it. He said that CBDCs are essentially liability of the central bank and asset of the holding public. It is exchangeable one-on-one at par with the physical currency, with only the form being different, that is digital. If you look at the graphic on the right-hand side, you will see the guiding principles of CBDC, and they are all intertwined with the core being trust. So if you look at the first guiding principle, it's integrity. So here the ownership is established and the value will remain intact. Since it is a currency that is issued by the central bank, liquidity will not be an issue. And also because there are no intermediaries involved, there is no settlement risk. And therefore, it ensures finality of payment. Once the payment is made, it's final. Now, what is the aim of launching CBDCs? It's basically to replicate user experience of dealing in physical currency with the digital platform without any risks, and real time, 24/7, 365 days a year. If you look at this slide, we're here talking about the catalyst. What has been the reason why suddenly there has been a flurry of activity in the CBDC space? We can actually go back to the global financial crisis. In the aftermath of the global financial crisis, a whole new parallel world of private digital currencies came into the picture. And here we are talking about non-sovereign backed cryptocurrencies. And Bitcoin is the most famous one. Today, you have more than 16,000 cryptocurrencies, operational in the market. Now, the very ethos of these non-sovereign backed private currencies is decentralization, and the way it is expected to function is that it was geared towards circumventing the established, regulated, and controlled financial system, the traditional financial system. And because of this, there are risks involved, because cryptocurrencies could then be used for financing illegal activities like money laundering or terrorism financing. But then if you look at the chart on the right hand side, you will see that these cryptocurrencies by and large have been very, very volatile. You look at the graph, Bitcoin, I've just charted Bitcoin here. You will see that over the last 1 year, there has been significant price movement in Bitcoin. So therefore, these cryptocurrencies were viewed more as an asset class for investment and not really as currency for the purpose of exchange. But then there was an improvement, and stable coins came into the picture, which aimed at tackling the very problem that cryptocurrencies had, that is volatility. And the way it was expected to be done is it was to be pegged to a stable reserve, and the reserve could be either a currency or a commodity. So currency could be the US dollar or any currency, the GBP, and as far as commodity is concerned, it could be like gold, financial, and any other financial instrument as well. Now, so what happened with the creation of these stable coins is that the very problem that existed with cryptocurrency got arrested. So volatility was taken care of, and then it was more modeled on the central bank currency. It was more like tokenizing your central bank currency, the traditional currency, the physical currency. So therefore, this created a fear in the minds of central bank. They felt that this could result in currency substitution, and therefore central banks thought it necessary to innovate, to serve public interest, and to also ensure that they are present in the digital space so that the monetary sovereignty is safeguarded. Now, central banks wanted to ensure that they are technically and functionally at par with stable coins, the non-sovereign backed stable coins, so as to ensure that there is not widespread adoption of or proliferation of stable coins. Because if that were to happen, then there would there are questions raised on how will the central bank be able to control the financial system, or what will happen to monetary policy transmission. And therefore, you will see a lot of activity happening in the CBDC space. We come to the international CBDC journey. As of recently, 114 countries representing over 95% of global GDP are exploring CBDCs. This is as per the Atlantic Council Geo-Economic Center research. 19 out of the G20 countries are considering issuing CBDCs, with majority of them moving beyond the research stage, which means they've already gotten to pilots. In 2023 alone, over 20 countries are expected to take significant steps towards piloting CBDC. And some of these countries have already launched their pilots, like India, for example, launched pilots at the end of 2022 and will continue to do pilots this year. The other countries that we're talking about include Australia, Japan, Thailand, Brazil, South Korea, and Russia. The ECB has indicated that it would perhaps start pilot only in 2024. Now, China has been exploring CBDCs very early on. In fact, right since 2014, they have been looking at CBDCs, and in 2019 they launched their pilot. Today, their pilot covers over 260 million people, and this year in 2023 it is expected to cover most of the market. 11 countries today have fully launched the digital currency. Jamaica is the latest entrance, and it has launched the JAMDEX. The first country to launch CBDC has been the Bahamas. They launched the Sand Dollar, and then you had Nigeria launching the e-Naira, and you have the Eastern Caribbean Central Union, also called the ECCU, cluster of 8 countries. They launched their Dcash. Now, if you look at the number of countries that have launched digital currency, very few, only 11, and among them you'll see that no big country has really taken the plunge so far. That is because countries want to be careful to ensure that the use case of CBDCs is properly established, and that it has something over and above what the current system has to offer. Now, there are some learnings from launches that have already taken place. So, for example, in case of Nigeria, which launched the e-Naira, only 0.5% of the population actually uses the CBDC, and contrast that with the proportion of the population that is using cryptocurrency, 50%. So you see that unless people see that there is really a use case, it will not see widespread proliferation. Now, Nigeria has taken steps to encourage the adoption of CBDC. Recently, they introduced restrictions on cash withdrawals. The ATM daily limit was set, and weekly limit was set. Despite that, it has not resulted in an increase in adoption of CBDCs. It has actually resulted in revolting. So therefore, it's very important that the use case has to be properly established. Then you look at the second country that has launched CBDC, the Bahamas. Only 0.1% of total currency in circulation is in the form of CBDCs. And ECCU, the cluster of 8 nations, early last year in 2022, they witnessed a technical outage. And for over 2 months, the CBDC infrastructure was not functioning. So no new customers could be onboarded, and no new transactions could take place. So these are things that you completely want to avoid. And therefore, you will see that, large countries are taking their time to do pilots. And and eventually, only once there's a properly established use case, they will probably look at launching CBDCs. We come to the motivation for RBI. RBI released their concept note in October 2022, where they have outlined what the goals are, what they intend CBDCs to achieve for them. We will touch upon each of them briefly. Reduction in the cost of physical cash management. We all understand that physical cash management is not an easy exercise because it involves printing of currency. There's logistics and distribution involved, and then paper currency is subject to wear and tear, and then replacement cost is involved. RBI specified that in FY 2022 alone, close to 50 billion rupees was spent just on printing currency. So the idea is, if CBDCs are launched and there is significant amount of adoption of CBDCs, it will reduce the cost of printing and other associated costs, and therefore lead to cost savings. The second goal is safer alternative to private digital currencies. The private digital currency space has seen an upheaval in 2022, and we are seeing the spillover effects in 2023 as well. Last year, you saw the stable called Terra, which is supposed to be stable, proved to be anything but stable. It collapsed. And then you had the FTX filing for bankruptcy. FTX is a cryptocurrency exchange. And recently you had, Silvergate collapsing and Signature Bank winding down operations. So there's been a lot happening in the private digital currency space. RBI feels that for people who want to use digital currency, the central bank currency should be available to them because it's a safer alternative. Streamlining cross-border transactions. This is an area that is really ripe for change. Even today, cross-border transactions are time-consuming and they are costly. Now, CBDCs through atomic settlements, can ensure that cross-border transactions take place real time. And if that happens, it would be really beneficial for India, given that remittances to India are the highest in the world. In fact, World Bank stated that in 2022, India received $100 billion in remittances in 2022. So if cross-border transactions are streamlined, it could really be beneficial to the public at large. Foster innovation. RBI has been very clear that they want CBDCs to complement the existing payment infrastructure that is already there. And so what will happen is, with the launch of CBDC, competition would be introduced. And generally, when competition increases, it aids innovation. Financial inclusion. Now, this is one of the very vital goals, for not only for India, for many countries. They're looking at financial inclusion to be crucial for the success of CBDCs. In fact, the Honorable Finance Minister of India, in her budget speech, when she first spoke about CBDCs in FY 2022, she spoke about financial inclusion and reduction of cost of physical cash management to be key goals to be achieved. Now, financial inclusion can be achieved through the offline functionality, where transactions, can be conducted without the need to constantly be connected to the internet, and also because the retail CBDCs, when they are launched, it will be token based, so there is no need to have a bank account, to transact. So that would aid financial inclusion and enhance digitalization. So if you look at this, the charts over here, India is very uniquely placed. If you look at on the left-hand side, digital payment transactions, they have been largely on the rise. And if you look at cash in circulation, that has also been on the rise. Ideally, you would have expected the cash in circulation should have reduced if digital payment transactions are on the rise. But what happens in India is that for small value transactions below 500 rupees, most of the transactions largely happen in cash, and that is an area that CBDCs can really work because of ease of use and also because of finality of payment. Now, if you look at the CBDC goals in the global context, they will differ from country to country. There is no one size that fits all. That is because it will depend on what is the maturity of the payment infrastructure in the country, what is the extent of digitalization in the country. So if you look at financial inclusion, this is an excerpt that has been taken out from the IMF report. If you look at financial inclusion as one of the goals, you will see, with the exception of Sweden and Canada, all the other countries are looking at it. Now, the reason why Sweden, is not aiming at financial inclusion, because today 97% of transactions in Sweden, take place digitally. If you look at, the goal preventing the illicit use of money, Bahamas is the only country that has identified that as a goal. That is because even before they decided to launch CBDCs, they were looking at, preventing the use of preventing the illicit use of money. And then if you look at competition, similarly, you will have not all the countries looking at the same goals. What I'm trying to say here is that it will differ based on the internal situation in the country. CBDCs in the Indian context, again, RBI in its concept note has given us color on, how it expects CBDCs to, to operate when it is launched in the country. So we'll first get to the types of CBDCs. You have two types of CBDCs. You have the wholesale CBDC and you have the retail CBDC. The wholesale CBDC is primarily for banks and financial institutions, with the use case being interbank transfers and wholesale transactions. Now, the aim of launching wholesale CBDCs is basically cost reduction and enhancing efficiency, because the settlement guarantee infrastructure that is in place when intermediaries are involved is not required. And also the collateral that is required to mitigate settlement risk becomes redundant. Wholesale CBDCs also enable conditionality of payment, that is settlement on the condition of a delivery of an asset or delivery of another payment. Then you have retail CBDCs. Retail CBDCs is available to the public at large, that everybody can use it. It gives you direct access to central bank currency. And the only other way we can have direct access is to central bank currency is through physical currency notes. And it offers finality of payment. Now, RBI has decided that it will explore both wholesale and retail CBDCs because it perceives each of it to offer unique advantages. Now, here I would like to stop and give you some color on, what is panning internationally. So many countries, including the very large countries, are first looking at wholesale CBDCs. They're looking at, focusing more energies on wholesale CBDC for the simple reason that it is easier to implement wholesale CBDC as compared to retail CBDCs, which are far more complex. But RBI has decided to, target both together, and pilots are, will be conducted for both. If you look at CBDC form, CBDC could either be account-based or token-based. If it is account-based, records of transactions and balances will be maintained of all the CBDC holders, all the holders of CBDC, and two things would be required. Verification of ownership would be required, and a check on the account balance would be required. If the CBDC is token-based, it is like a bearer instrument. Whoever holds the token is the owner of the owner. Here, the verification of the token, of the authenticity of the token, is required, and not of the owner of the token. The tokens would be stored in a wallet, and any holder could spend it using an app, and it will engineer a higher degree of anonymity because authenticity of the token only needs to be established and not of the owner. Now, as far as RBI is concerned, they have decided to use account-based CBDCs for wholesale CBDC and token-based for retail CBDC. The reason why token-based has been selected for retail CBDC is to ensure that it is as close as possible to cash. Only then it will entice widespread adoption of retail CBDC. Now, issuance and management, this will give us some color on what is the role that private, intermediaries will play if CBDCs are launched. So CBDCs can be launched through a single tier model where no intermediaries are involved, or through a two-tier model where intermediaries are involved. So if you look at the single tier model, which is direct, the central bank will do everything, right from onboarding to handling retail payments to handling customers, everything. There is no anonymity because all transactions will be recorded by the central bank. Now, if this is adopted, there are two challenges here. One is the central bank will have to get into doing things that it is not used to doing, like handling retail payments. So, which means an infrastructure around it would have to be built. And secondly, if the central bank opts to do all of this by itself, then it would undermine the role of intermediaries, which you generally do not want, because innovation happens, in the private space. If you look, the second one is a two-tier model, indirect CBDCs. So here you would see the customer onboarding and payment processing will be done by the intermediary. The central bank will only track wholesale CBDC balances. And if you look at the hybrid model, again, intermediaries are involved. They would be responsible for onboarding and executing payments, but where the difference is that the central bank will maintain a ledger of all the retail transactions, which is not the case in the indirect mode. Now, the indirect form is basically closest to what is currently in place, and since RBI is very clear that they want the CBDC to be non-disruptive, to coexist with the current payment infrastructure, they have chosen the indirect mode because it will be the least disruptive one. Technology choice. Now, since CBDC is a digital product, technology will play a very, very important role. In fact, it's going to be the heart of it. When technology comes into the picture, you have to make sure that it is scalable, it is secure, and it is transparent. There are two technology choices. You have the distributed ledger technology called DLT, which is part of DeFi, decentralized finance, and you have CeFi, which is centralized finance, which is the legacy technology. Now, in the legacy technology, record keeping is centralized and with access only to the network owner, which is the central bank. But in case of decentralized technology, DLT technology, the very ethos is decentralization. So it's a decentralized way of recording and sharing data. Three features define it. One is the ledger is stored in multiple locations. Updation in the ledger is done through a consensus-based mechanism, and is that it has cryptographic security. Now, DLT technology, if adopted, could be permissioned or could be permissionless. Now, if it is permissioned, then only authorized entities will be able to update the ledger through the consensus-based mechanism. But if it is permissionless, anybody can update the ledger through the consensus-based mechanism. Now, permission ledgers can be either public or private. If permission ledgers are public, then anybody can view it. But if it is private, it can only be viewed by authorized entities. Now, RBI has not decided on which technology it is going to select. In fact, it says that they're using multiple technology stacks for different pilots, and based on the outcome, they will determine which technology they will use. Just to give you some international perspective here, China, the PBOC, has decided to use a hybrid model. That is, they're using DLT and legacy technology in combination. The reason being that they felt that the DLT technology will not be able to handle the volume of transactions they're looking at, and they were not happy with the way that the data is getting stored. If you look at Thailand has actually done a pilot using the DLT technology, and what they felt is that the moment conditions are introduced, then there are computational issues. On the other hand, the two countries that have launched CBDCs, the Bahamas and ECCU, they are actually using the DLT technology. Now we come to the CBDC design features. The design features are very vital because that will enable CBDCs to achieve the goals that it is launched, for which it is getting launched. The design features are also important because it will help to surmount any of the risks that are perceived with implementation of CBDC. In fact, a study conducted by MIT states that CBDCs can do a lot of public good provided it is designed in the right fashion. We look at some of the features of CBDCs. You have programmability, offline functionality, restrictions, interoperability, and anonymity as the features. We will touch upon each of these briefly. So if you look at programmability, this is going to be one of the vital features, which could also be one of the key differentiators over the existing payment systems that you have today in the country. So you have programmability can be done via smart contracts. So you have it is important for both domestic and cross-border transactions because it will enable you to do atomic settlement real time. International payments can be automatically settled if conditions are met, triggering payment in one currency once funds have been received in another. And then you have purpose-based CBDCs. This is similar to vouchers where the end use is actually tied. But this is very useful when subsidies are being doled out or relief packages are being doled out, especially during COVID. And in India, you have subsidies given, to buy fertilizer. So the end use can be restricted only to, to those outlets which, sell those agricultural products. So this will ensure that, the subsidies are getting used for the purpose that it has been given. But there has been some hue and cry, in many countries over purpose-based CBDC, purpose-based feature. I'm sorry, because it is felt that you're giving excessive control in the hands of the government and the central bank because they will be able to control how much and where you're using your CBDCs, and this is a concern, especially in authoritarian regimes. Then you have restrictions. The restrictions could be remunerative and non-remunerative, and you could also have quantitative restrictions. So when you talk about remunerative, it is very similar to interest being paid on your saving bank account. So if the CBDC is remunerative, then whatever CBDC balances are there, you will receive an interest on it. Now there is a problem with this because then you're competing with banks, and this could result in banks losing their deposits, which could impair credit creation process, increase the cost of funds for them, and affect their margins. And this is not a scenario you would like, because that would mean in order to maintain margins, banks could take up additional risk. You have non-remunerative CBDCs where no interest will be paid on the CBDC. It is very similar to cash. The cash that you hold in your wallet does not earn you any interest. So similarly, if you want the CBDC to be closest to cash, then it should not earn you any interest. It is less distortive. RBI has chosen the option that is closest to cash. So CBDCs, when launched in India, will be non-remunerative. Offline functionality is also it's very vital because this is also one of the features that will give CBDCs an upper hand over the payment infrastructure, the payment options that are already there in the country. Now, by offline functionality, we mean that the ability to carry out a transaction even if you're not always connected to the internet, or if there is electricity supply is an issue. BIS survey of central banks in emerging market economies ranks offline use as the most important feature to promote financial access, because there is a strata of population that does not have access to internet or to electricity at times, and if the offline functionality is available, then it could get that portion of the population into the digital net. Several financial experts opine that if CBDCs cannot work offline, then it is not a viable cash replacement. And that is the kind of importance that is accorded to offline functionality. In January 2023, the Central Bank of China, PBOC, has launched offline CBDCs using the near-field communication technology. Now, there are two concerns that are there with offline functionality. While it is desirable, it is also very difficult to implement because storage will be hardware-based, and when hardware comes into the picture, then you could have the problems of damage, or it could get stolen. So those issues need to be tackled. Interoperability is important from the perspective of domestic as well as cross-border transactions. It is important for CBDCs to be compatible with the existing payment infrastructure that is in the country, and also to be able to speak to other CBDC systems, which will enable money to move seamlessly. Basically, cross-border remittances is what we're talking about here. Now, this should be considered at an early stage, both within and between jurisdictions. Now, between jurisdictions, it really needs to be considered early on because of the complications involved. You have governance standards which differ from country to country. You will have anti-money laundering rules which are different. You could have currency controls. You could have capital controls. So all of those things need to be taken into consideration to ensure seamless movement of money from one country to another. Now, the advantage with CBDCs is that it's allowing you to start from a clean slate, and therefore, you can actually collaborate with other countries and create a common bridge, iron out the differences, so that instant cross-border transactions become a reality. Now, the way this is being worked out is that BIS Innovation Center is collaborating with different countries, and they are doing pilots for both wholesale and retail CBDCs. India has so far not participated in any pilot. It has not collaborated with the BIS Innovation Center, but that is expected to happen at a later stage. But work has already happened in this sphere. Project Dunbar is a project that is a multi-CBDC project, which involves the Central Bank of Singapore, Bank Negara Malaysia, which is the Central Bank of Malaysia. It also involves the Reserve Bank of Australia and the Central Bank of South Africa. So they have done pilots. They have done a pilot. The prototype has been tested, and the technical feasibility has been established. They have to decide on the next steps. Another quite famous project is mBridge. It is a multiple CBDC platform involving the BIS Innovation Center along with the United Arab Emirates, Public Bank of China. You have the Central Authority of Hong Kong and Thailand collaborating together. They have already done the pilot transactions. What $22 million have already taken place. Now they are looking at the outcomes of the pilot, and they will introduce additional features, and more pilots will be carried out. Recently, BIS announced that Project Iceberg, which is a retail wholesale CBDC project, was just completed. That was done with the Bank of Israel, central banks of Sweden and Norway. The good news is that the feasibility of retail CBDCs have been established through. They feel that if the hub and spoke model is used, it is something that that is possible and time and cost efficient. Anonymity. This is a key trait of cash, and therefore, as far as is possible, if you want CBDCs to be close to cash, this is a feature that will be important. But then with greater anonymity comes, larger risk of illicit use, and therefore a fine balance has to be achieved between anonymity and compliance. So the way central banks are looking at it is they're looking at tired wallets. So the lowest threshold will be given maximum privacy. And then, for higher value transactions, so to say, compliance is required, meaning it will have to go through, AML checks and anti-money laundering checks and CFT checks. What RBI is doing is it is also going to test the anonymity feature for low value transactions when they are piloting the retail CBDC. So once the CBDC is transferred to the customer wallet, it will not be tracked by banks. Now, again, if you look at the international context, you will look at it, largely the features will depend on what goals have you set for yourself. No country, if you look at remuneration, no country that has launched a CBDC has launched a remunerative CBDC, and no country really has decided to go ahead with a remunerative CBDC so far. Canada and Sweden remain undecided. And if you look at the offline functionality, more or less, most of them are looking at offline functionality or are exploring it. And as far as cross-border payments are concerned, you will see that international collaboration is the way to go. Many countries are not looking at it, to begin with. Even India is not looking at it right now, but yes, in the future they will look at international collaboration for cross-border payments. The risk, need, and the present situation. Now, CBDCs is a digital product, and there are risks involved, and we'll just touch upon what are the risks that need to be taken care of, and these can be mitigated or surmounted through the design features. So, privacy is the first risk. Cash is unrivaled in its ability to to provide anonymity and privacy. When it comes to digital transactions, there is definitely going to be a digital footprint. 100% privacy cannot be provided. So therefore, a fine balance will have to be struck between privacy and law enforcement in order to ensure widespread adoption. The way central banks are planning to do it is by setting controls, regulations on data sharing, like who can see the data. So obviously the data sharing should be done only to the entities that are responsible or need to see it to do the regular checks and balances. And then the other way to do it is through tiered wallets. So the low, where the threshold is low, the transaction values are low, probably it will not go through very stringent checks. Cybersecurity is really a serious concern, because if you look at it, since CBDCs are a digital product, digital frauds are widely prevalent, and then you have even ransomware attacks that take place. So this is a risk that really needs to be taken care of in the design phase itself. In fact, if you look at Federal Chair Jerome Powell has touted cybersecurity risk as to be one of the key risks in implementation of CBDC. That is because sensitive payment and user data is at stake, which could be easily misused and stolen. Now, in order to ensure that you have a, so to say, foolproof system, at the pilot stage itself, you need to have efficient risk management practices. You need to have a governance framework which will take care of the cybersecurity risk. And then, despite having a well-rounded system, if the system were subject to attack, how would you recover the system and get it back online? So those need to be considered at the pilot stage itself. Financial disintermediation, this is also a risk, because CBDCs are very safe. So when in times of crisis, like if there is a financial crisis or there is a hint of financial crisis, people will move money to CBDCs because they are absolutely safe. So this could result in, it could accelerate the contagion effect. Even sometimes you would have the situation where a particular bank or a financial institution is weak, and when that news spreads into the market, people will just, it's easy, it's fast to move money out on the digital platform. They would just move money to the CBDC platform, and that could really accelerate the downfall of the institution. And therefore, in order to take care of this, limits can be set on CBDC holdings. How much can be held in the form of CBDCs? CBDC launched the case for India. India has a very well established payment infrastructure in place already, and then you have UPI, which is touted globally to be easy to use, to be efficient, time and cost efficient. Then you have all the other payment systems alternatives. You have NEFT, you have RTGS, you have the various wallets, you have Bharat Pay. In the midst of all this, in an already crowded environment, do you need to add something new to it? Now, the answer to that would be yes, you need to. If you look at it in context of what I will share. First of all, is money has evolved over a period of time from being commodity to metallic to paper. And now we are probably in a transition phase where everything is moving digital. So therefore, accelerated by the pandemic. Therefore, it is essential to move with the changing times and to embrace change. Secondly, you need to innovate and stay relevant so as to ensure that central banks continue to serve as the foundation of the financial system and the overall economy. So you have seen innovation happening in the private digital space, especially with the launch of stable coins. Now you need to make sure that because stable coins today are superior, vis-a-vis the private, the payment infrastructure that we currently have, because there are no geographical boundaries, and then you have real-time settlement that's also there, across the globe. Now you need to have a digital solution, that is functionally and technically at par with what private digital currencies have on offer. So if CBDCs are able to provide that, it will prevent traffic from moving into the private digital currency space. Because if that happens, then you have concerns on how will the central bank control the financial system and how will it ensure monetary policy transmission. And therefore, to ensure that central banks continue to remain important and relevant, it is important to look at CBDCs. Provide a safer and trustworthy alternative to private digital currencies that witness abnormal levels of volatility. Yes, you do have stable coins, which are an alternative in the sense that they are supposed to not be as volatile as the regular cryptocurrencies, which are not backed by anything. Especially stable coins which are backed by currency, they're as good as your fiat currency. But there are also challenges, like you will see what happened recently. The stablecoin USDC issued by Circle, it actually lost its peg to the US dollar because it maintained its reserves in Silicon Valley Bank, which actually collapsed. So there were concerns on what is going to happen to the reserves, but the peg was restored. Once the Federal Reserve came out and said that they will take care of the deposits, but temporarily it did lose its peg, and if there is loss of trust, it could lead to a collapse. So therefore, it is important to ensure that people are provided with a safer alternative, and there could be nothing better than a central bank digital currency. Then you come to technology. Technology is changing, and we have seen that technology has the ability to really change the landscape for many industries. With DLT technology, in the financial world, there are a lot of things that can be done, or it promises, it seems to be pretty promising. Things like programmability, things like offline functionality, cross-border streamlining, cross-border transactions are things that potentially it can provide. And if it can bring that kind of an improvement, it would do a lot of public good, especially to a country like India, where remittances are so high. So if we are able to streamline, ensure interoperability and streamline cross-border transactions, it would be beneficial to the public. Also, I would like to mention here is that we live in a global world, and it is also very important to stay for RBI to stay abreast with what is happening globally. You will see, as I mentioned earlier in the presentation, you have so many countries currently looking at CBDCs, and therefore it is important that RBI is not left behind, and that they understand what is happening and they are future ready. So in case there is some significant change that happens in the payment ecosystem, then they are ready to respond. And to be ready to respond, they have to be doing the groundwork, and therefore it is essential to explore CBDCs even if they decide not to launch it in a hurry. Present day situation in India, wholesale CBDCs the pilot has already started on 1st of November 2022. It is aimed at facilitating a more efficient secondary market settlement for government securities. Subsequently, RBI will focus on other wholesale transactions and cross-border transactions in upcoming pilots. Here is when I think when they start looking at cross-border transactions, they will essentially look at possibly collaborating with the BIS Innovation Center and other countries. Then you have retail CBDC. The pilot was launched on December 1st, 2022. It basically would involve both peer-to-peer and peer-to-merchant, person-to-person, and person-to-merchant transactions. So the way it is it is working currently is that it is only accessible to a closed user group of customers and merchants. 8 banks have been identified, and the implementation is phase-wise. So the first phase, you have 4 banks will be involved, and then later 4 more banks will join in. An assessment will be done on the creation, distribution, and retail usage of digital rupee in real time. And based on the outcome of the pilot, other aspects would be tested in subsequent pilots. Here, I would like to mention that RBI, while work is being done on pilots, RBI is very clear that multiple pilots will take place, and that they are not really in a hurry to launch a CBDC. They will see what the use case is, and only then decide on when it really needs to be launched. Now we come to the last slide, which is the key takeaway slide. In a golden era of currency digitalization, accelerated by the development of private digital currency, the question no longer remains if, but when the future of, but when. Definitely the future of money is going to be digital because we are all moving to the digital space. CBDCs marry trust and technology to create a digital product that is safe. Internationalization of CBDC through the interoperability feature will be the game changer, and this is really important. If you're able to achieve this feature, it will really be beneficial. A return on effort will totally be dependent on the use case, which has to stand out vis-a-vis the existing online digital payment alternatives. See, it is important for CBDCs when they are launched that it is able to provide something over and above what the current alternatives provide. Only then there is a case, and it will lead to widespread adoption. Well-structured CBDCs, which encompass all the desired features along with having a robust risk mitigation framework, will ensure successful adoption. So I end here, and I'm happy to take questions now.
Thank you, Rosita. That was very comprehensive take on CBDCs. I think I learned a lot, so thank you for that. Let's just give a couple of minutes to Rosita to go through the questions that are coming in. In the meantime, I'll take this small windows to sort of show you what we have on the EMIS platform. And as you can see here, this is the EMIS platform, and we have a lot of data on companies, on industries, and then country level data as well. This, of course, there is a big focus on emerging markets. And if I just try to sort of look at EMIS Insights, and I can find the reports here. And as you can see, we have quite a few reports. These are built by our research team, and people like Rosita, thank you so much, are writing a lot of these reports. So here you can, if you scroll down, we can see that the digital rupee, here is the report. This is one of our special reports on the digital rupee, and you will find many such special reports on our platform. So just a quick glance at how this looks like. And yeah, so today's webinar was sort of an amalgamation of this plus whatever is happening now, and I think it was Rosita covered everything very nicely. Okay, without further ado, I think we can sort of go back to the questions. And Rosita, are you ready for the questions?
Oh yes.
Okay, so let's see. 1 second. All right, so let's see. Till when can we expect India to move at least 75% of the transactions happening through CBDC instead of physical currency? It's a great question. Would you like to take that?
Yes, that's a very challenging question because CBDC has not yet been launched, and if you look at in countries where CBDC has already been launched, we have not seen that kind of adoption, and therefore time and again in the presentation I've said that the use case has to be properly established. People have to see value in in the launch of CBDCs. Only then it will lead to widespread adoption, which is why you see most of the countries are taking time to launch retail CBDCs. So if you ask me now, India has still not launched. It is going to take some time to launch, and adoption will totally be dependent on how superior the product is over what the current offerings are in the payment space, and also on how successfully the central bank is able to educate the masses on adoption of CBDC.
Could you explain how the use of digital currency could help cross-border transactions, especially in FDI transactions?
You'll have to repeat because I couldn't hear you clearly there. Can you repeat the question?
Okay, yeah, sure. So the question is, could you explain how the use of digital currency could help cross-border transactions, especially in FDI and mergers and acquisitions related transactions?
Well, on mergers and acquisitions and FDI transactions, I would not be able to throw color, but generally speaking, CBDCs are expected to have the interoperability features, which means that the system should be able to talk to each other. So you have like I spoke about the various projects that are currently going on. You have multi CBDC platforms, and if you have countries on that multi CBDC platform, then transactions through the interoperability feature, cross-border transactions should take place. And I don't see any reason why FDI or M&A transactions cannot take place if the interoperability feature is in place.
Yeah, I was just sort of thinking about that. The interoperability feature is actually maybe that would be helpful. There is one more question here. Can you please elaborate on the differences between indirect model and hybrid model of CBDC? Rosita,
Okay,
if it helps, you can go back to the presentation. I can just give you back the control if you think
okay,
that'll help.
Yes, I'll just go back to that slide in that case.
Yeah.
Okay, if you could see my screen here, you would look at it, you could see you're looking at the difference between indirect and hybrid. So both of them are two-tier models where you have intermediaries involved. The intermediaries will do the payment processing, the onboarding of customers, the handling of. Sorry,
Rosita, sorry to. Yeah, no, we can't see your screen if you're sharing. Just wanted to.
Okay, just a moment. Can you see it now?
Oh yes, we can. Okay. Sorry about that. Yeah, please go ahead.
No, that's fine. So if you look at the slide, you will see that indirect and hybrid, both of them are two-tier models. In both cases, customer onboarding, payment processing, and all work related to the retail customer will be done by the intermediaries, which will be the banks, essentially the banks. But where the difference is, in case of indirect CBDCs, the central bank, which is RBI, will only track the wholesale transactions, wholesale CBDC balances, like they're doing currently, in case of normal transactions also. Where the hybrid model is concerned, the central bank will maintain a ledger of all the retail transactions. So which means a periodic update will happen of all the retail transactions. Now, hybrid is considered to be slightly superior in a way to indirect model, because in case of hybrid, if there is a problem with the system, then the central bank infrastructure can be used, to bring the system up. But then there's also a question of privacy here, yeah? Because in case of the hybrid model, the central bank will have access to all the retail transactions, and therefore, there's that, the indirect model, is better over there, because there is greater privacy, as the central bank will only maintain wholesale CBDC balances. Have I answered the question, Rohini?
Yeah, I think you answered the question. Thank you, Rosita. I found a very interesting question here, which I think was going through my head as well. That let's say if you're, the CBDC is launched, and how do I really start using it? So can you demonstrate like a practical example of opening a wallet or transacting with the CBDC? How would that go?
Okay, so essentially right now we are only in the pilot stage. So how it is currently functioning is that you have participating banks. The participating banks will select, some users to get involved in the pilot. They will essentially send you a link via email and via an SMS on the mobile, and then you need to download the app, which is the CBDC app. You will download the app, the wallet rather. You would download the wallet, and what happens is, since there's a mobile number that is used when you register your account, your CBDC wallet will be linked to your bank account, and then you can move money from your bank account to the CBDC wallet. And where you can use it is, the merchants which are currently involved in the pilot. So you have Reliance Retail, one of the the biggest retailers in the country, is also involved in this pilot. So you can use it at Reliance Retail outlets. The QR code can be used to transfer money when you've made your purchases. So that's how it functions currently.
Okay, great. Thank you. So maybe just one more question. So let's say if there's somebody who does not have a bank account, can they use a CBDC as well?
That is essentially what RBI is trying to do. So when RBI spoke about launching retail CBDCs, they are very clear that it's going to be token based, and in the token based model, it allows you to enable customers to have access to the digital platform without the need for an account. So that is the objective, because you have some strata of the population that either does not have a bank account or does not want to have one. So how do you get them into the onto the digital platform? So token-based CBDCs is the way, and which is why RBI has chosen the token-based CBDCs to be launched, the retail CBDCs to be token-based.
Got it. So there's one more question we have from the audience here is what exactly interoperability means in the case of CBDC, and is there any case which can be highlighted? So if you can give an example, perhaps explain the interoperability bit.
So the interoperability is basically, CBDC systems of two countries talking to each other, being compatible with each other, through standardized rules, standardized inputs, outputs. Yes, example I can give you, if you look at project emergence that I spoke about earlier in the presentation, it is actually a wholesale CBDC pilot that has taken place. There, they have 20 banks have participated in that across the 4 jurisdictions that are involved there, the 4 countries that are involved there, and there they have been able to seamlessly move money real time. The total transaction value was $22 million, which is not a, which is a decent sum of money to, transact within the 4 countries. So they have successfully done that, and what they are intending to do is, based on the outcome of this pilot, they will introduce more features to see, how it shapes up. So that is what we mean by interoperability, the ability to, to move money to, to a particular country real time. So that is something which is not possible today because you have correspondent banks involved. So there is, it is costly and it's also time consuming. So if this interoperability feature, is part of the design, then it would really be very advantageous.
Excellent.
In fact, okay. I should mention one more thing, while innovation is happening in the CBDC space, that is not to say innovation will not take place in, in the current payment system that is already there. The reason why I'm saying this is recently at the end of February, Singapore's Pay Now, which is their app, Pay Now app, and India's UPI, they actually have launched a cross-border service, so you can actually move money to Singapore real time, and it's also cost efficient. So, innovations are taking place on the cross-border side, even though it's not on the CBDC platform.
Rosita, just like quickly here, out of my own curiosity, when we're moving it cross-border, then how does the, do you know, like how would the exchange rate of work on this? Because different banks, sometimes have different rates, but in this case, because if it's a central bank currency, would it be sort of using the central bank rates, exchange rate or something?
No. So the way I understand that it functions is that you will have, rates given provided by 4 or 5 banks, and the bank that provides the best rate will be used in the settlement process. So basically, as a customer, I don't choose, but banks will, there would be multiple banks involved who would be providing the FX rates, and the bank that provides the lowest or the best FX rate, that bank will be used to execute the transaction. Right. Which is what any customer would look at as well.
Yes, exactly. I mean, I would prefer that. So, okay, we have one more question. Do the token-based transactions get tracked?
Basically the token-based transactions are supposed to be closest to cash, because what happens is you basically need to ensure that the token is authentic, and the ownership is not basically validated. Having said that, it is on the digital platform, and therefore, while it is more, it gives you more privacy as compared to account-based, there will be some digital footprint.
Okay, so we have one last question. We just have time for this one last question. What is the difference between CBDC and UPI net banking payments? I think this is a very nice one. Yeah.
UPI basically is not a currency, essentially, right? CBDC is a currency. UPI is essentially a payment platform. And then in case of, so basically in UPI, what happens is when a transaction happens, a debit credit transaction happens, behind the scenes, there is a settlement infrastructure that is there, and the settlement needs to take place by the intermediaries. But in case of CBDC, you do not need to have any kind of settlement infrastructure in place because there are no intermediaries, and there is a trust element, and the central bank ensures finality of payment. So that is one of the key differences. Over and above that, in UPI or any other platform, things like programmability, which I spoke about earlier, like where the end use can be restricted, those things so far cannot be done. So that is where, probably a CBDC will have an edge or will be different from, UPI or any other payment platform.
Thank you so much, Rosita. I think we're out of time now. We have a lot of great questions coming in, and we'll get back to all of you over email, we promise. But for now, thank you very much, and please let us know if you'd like to check out some of our insights. And I showed you the EMIS platform, so in case you're interested in looking at the platform or what we have, do reach out to us, and we would be happy to arrange a session with you separately. On that note, thank you very much and goodbye. Have a great rest of the day. All right, bye for now.
Thank you very much.